Welcome to Investors Guide. Thank you so much for tuning in. This is a very interesting time to take a look at all of your finances. I hope you've already filed your taxes for the year. But we've seen the Sensex now move into a slightly more stronger space. The RBI governor decided, of course, this week not to change interest rates, but that keeps us hopeful that there will be a cut in the future. On the show this week, we'll tell you what investment strategy you should have if you're moving overseas. In our product review, we look at the Franklin India Prima Plus fund, and we'll tell you if you should be booking your profits from mutual funds at all. Now, joining me on the show, Kumar, the CEO of Value Research. Thank you so much for joining in.
Thank you.
The interesting part about today's show is that we have a lot of women investors who've written in, and that always makes me very, very happy. Our first question comes in from Bhavna. She tells us she'll be immigrating to Australia at the beginning of next year along with her entire family. Now, she's been investing in mutual funds since 2010, and she wants to know if she should continue the same investments. We don't know how much money she's putting in, but she's very interested to know what the tax implications will be if she can invest in Indian mutual funds from Australia, and if she should retain her insurance policies and her bank accounts. Now, first of all, Bhavna, congratulations on the big move. I'm sure you're very excited. And there might be a lot of other viewers who have family members who are moving overseas or who are moving overseas themselves. The rules are a little different for NRIs, but they can invest in Indian mutual funds. For Bhavna in particular, what advice would you give her?
Yes, one is that, she can continue to invest in Indian funds. But the way to invest in Indian funds as a resident is different from the way you invest as an NRI. There are two things one should be concerned about. One is avoid taking a short-term gain because TDS is applicable on that. And never, as an NRI, never invest in the, of course, even Indian investors should not invest in the dividend plan of an equity fund anyway. But there is no tax implication of that. For NRIs, it could be quite tedious because, so you should ensure that you are investing only in the growth plan of equity funds if you are investing for the long term. Because dividend payable to NRIs is subject to withholding tax, the tax deduction at source, and then you have to file your return to take a refund. So that is avoidable because long-term capital gains or investing in the growth plan, you will have all your accumulating in your investments, and you will not you will not derive your any return in the form of dividend, which is best avoidable. And long-term capital gains tax is tax-free, so there won't be any tedious there.
Also, Bhavna, the other thing you should remember is that the rules for capital gains tax, long-term and short-term for NRIs on property changed last year. There's a hefty tax deducted at source on all property sales made by NRIs. So sit down with a tax consultant, take a look at your entire portfolio. There are some things like, NRI fixed deposits or NRE deposits that are tax-free. Like Dhirendra is saying, mutual funds held for the long term, which is more than 1 year, will also become tax-free in your hand, which are great investments for you to consider. If you're considering holding on to property, buying property, selling it over the next couple of years, that's something you'll have to relook at with your tax consultant because the rules are different for NRIs. That's something you want to reconsider. And like we always say, make sure you have enough life insurance. Dhirendra, this is another question that a lot of NRIs ask us. They have life insurance policies in India. Does it make sense to buy a policy in the country of residence or to hold an Indian life insurance policy? What would you recommend, simply if you're talking about pure term life cover?
I think investor, NRI or anybody, any expatriate should be doing a term insurance shopping. If they find that, the term, wherever it is cheaper and looking at the credentials of the insurer, I think that should be the guiding force. And also one thing to be concerned about will be, if you are resident, if you are an expatriate, that information must be provided to the insurance company because the claims are to be taken here and you are residing elsewhere. So just in case one has to avail the claim, then how problematic it will be. That could be an issue.
All right, so that could be an issue. Take all of those things into consideration, especially since your family is moving with you. Reconsider possibilities of buying an insurance policy in Australia. Does it make more sense? Is it more affordable? And then consider what you should do next. Of course, you can write back to us anytime if you need any help between now and when you move. And after you move, we're available on the internet as always. Thank you so much for writing in. Let's move on next to our portfolio question. 30-year-old Deepak has written in from Hyderabad. He has a 1-year-old daughter and parents who are dependent on him, and he'd like to build a corpus of 4 or 5 crore rupees over the next 20 years for his own retirement. So that's really nice to hear from someone who has a nice long-term horizon, Dhirendra. He has sent us details. He has an income of 75,000 rupees, EPF deduction like anybody else, health insurance from his employer. Deepak, you must buy your own health insurance policy. Do not rely on the one that your employer gives you. Make it a point, especially if you have a young child and dependent parents, to buy health insurance for the full family. Now, he also has a life insurance policy as well and an emergency fund with 6 months worth of salary. He's putting 10,000 rupees in mutual funds aside, Dhirendra. But this is a very interesting question he has. He's written to us asking, in your aggressive policy, why is there a debt fund? Why is the need for a debt fund in any aggressive mutual fund portfolio? What's your response to that?
I think, any portfolio should have a fixed income allocation. The 10% allocation to fixed income, which is through a debt fund, is primarily to rebalance. And, whenever we are advising or whenever we are suggesting a portfolio, many a times that fixed income allocation can actually be derived from your EPF contribution or some other fixed income which might be a mandatory, or you just might be holding it. That should be taken into account. But periodic rebalancing is a very important thing for any investor. And as you would have seen that, when we go to the stable growth portfolio, the fixed income allocation is nearly 30%. In our growth portfolio, it is 20%. So we are actually moderating the risk with the fixed income allocation.
But Dhirendra, the other question he has is about the quantum long-term equity fund, which is also in our aggressive portfolio. He said, what is the need for a fund like this, given its large cap bias in an aggressive portfolio? Doesn't it make sense then to only look at mid-cap or equity diversified funds?
Any portfolio should be built on the foundation of a large cap fund. And I would say that we have been conservative even with our aggressive portfolio. And this portfolio should be dominated by aggressive funds and even mid and small cap fund. But I don't think over a full market cycle, and given that these are very low maintenance portfolio, we do not like to make changes often. We do not like to make changes based on short-term performance of funds.
But Dhirendra, he's also sent us his list of funds. While the rest of his portfolio seems perfect because he's following our instructions quite carefully, I'm a little disappointed in the fact that he has about 10 mutual funds in his portfolio. And if he's going to be running them for the next 20 years, that's a lot of management for one person to do. If you take a look at the list in front of you, Dhirendra, I'm not going to call them out because there's just too many funds. If you take a look at the list in front of you, would you like to trim it down, streamline it, bring it down to maybe 5 or 6 funds that would serve him well?
There are two ways of building your long-term aggressive growth portfolio. One is to have a low maintenance approach. In that context, with that in mind, he should have funds like, UTI Opportunity or IDFC Premier Equity. 2-3 such funds will take care of that need. The other way is, choosing his own, making a selection of mid and small cap funds himself, reviewing it every 2-3 years and making changes. And from that standpoint, I think, he should ideally have no more than 3-4 funds. That should be good enough, because what he's trying to achieve with an aggressive portfolio, by having these 10 funds, he will end up owning about 300 to 400 stocks.
So if you take a look at that list, Dhirendra, and we were actually, divide the two funds into funds he should be holding and funds he should be getting out of, given his specific needs. Now, this is given the fact that Deepak has the kind of time horizon he does. It does not mean these are bad funds. Dhirendra, what would you like him to hold on to out of this list?
The 4, relatively more diversified and well-performing aggressive funds to have in his portfolio will be, the ICICI Prudential Value Discovery or Mera Asset Opportunity, UTI Opportunity and IDFC Premier Equity. These 4 funds make up a full portfolio, and I think he should not go beyond this.
All right, so the list is on your screen, and if you have any more questions, you can get back to us. If you would like us to take a look at your portfolio, write to us. Our email ID is at the bottom of your screen. All right, so you know how on this show we keep telling you that you must have a term insurance plan. So what we're going to do starting this week is bring you regular updates of innovations in the market in products like term insurance and health insurance, so you know what's available and you know what's new. In fact, there was a policy that launched just this week. Take a look at this quick report.
A quick search on the internet would prove that the life insurance industry is becoming increasingly competitive.
Birla Sun Life Insurance. Khud ko kar buland.
ICICI Prudential Life Insurance.
Until now, term insurance products were standard and similar across the market with only the price as a differentiator. But now new features and benefits are being introduced to make the product more attractive. The newest addition, PNB's MetLife Mera term plan, attempts to combine several features into one plan. It not only lets you design your own payout options, but you can also increase your sum assured over various life stages. What's interesting is that the cover offers spouse benefit and addresses the need to secure child's education until the age of 21 as well.
We also have other flexibilities. We also have life term available with a cover available till the child is 21. So in a sense, you can have very high payments till the child is 21, because we discover that number of times people are in really big need of money till the child it stands on his or her own feet.
Interestingly, the plan also incorporates joint life cover with the premium waiver on the demise of the first life. The policy continues with the base premium otherwise. Let's assume Ramesh is the first life insured with a cover of 10 crore rupees. His wife Sakshi would get a maximum cover of 50 lakh rupees. Now they have a family cover. If Ramesh were to die first, Sakshi would get 10 crore rupees with the option of a lump sum or a regular payout. Her 50 lakh rupees cover continues without her paying any further premium. In case Ramesh outlives Sakshi, the 50 lakh rupees is paid out and he continues to pay the premium on his policy. If Sakshi was a housewife, however, she would get a maximum cover of 25 lakh rupees. While these features are interesting, choose your policy based on your life cover need and your comfort with the life insurance brand.
All right, it's time for us to take a quick break. On the other side, Dhirendra will stay with us. We're going to take a close look at the Franklin India Prima Plus fund. If it's in your portfolio, you want to stick around and hear that review. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review. And we're looking at the Franklin India Prima Plus fund. Now, if you're holding this fund and it's in your portfolio, you're going to be a very, very pleased investor. Avan will give you those numbers. Avan.
Thanks, Faye. The fund in focus this week is one of the most preferred funds amongst investors. That's the Franklin India Prima Plus. With an annualized return of 20% since its launch in 1994, this fund has had an impressive track record and is miles ahead of its competition. But how does its performance look in the recent past? Let's take a look at the performance chart over the last 5 years. Now you'll see that the red line, which is the fund, has consistently outperformed its benchmark and its category. In fact, it has performed better than its peers in a market downturn as well. Even the trailing returns of the fund show that it has performed well in the short and over the long term. The fund outperformed its benchmark and its category with a return of 20% in its 10-year horizon. In the last 1 year, the fund's performance has been stellar with a return of 33%. The fund has maintained its performance even during a recent change in management. With a stellar long-term track record, is this a must-have equity fund in your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Dhirendra, 5 stars on value research, stellar performer, 33% over the last 1 year. But it's really its long-term performance, its returns since launch that should make an investor happy. Is this the kind of fund that everybody should have in their portfolios?
Yes, it is a kind of fund. You know, if you have to choose 1 or 2 fund and just continue investing for the long term, this is a kind of fund. And if you look at, some of the interim period in its long history of, little over 20 years, I would say that, all years in which the market does extremely well, this fund struggles a bit. This is a relatively underperformer, and it makes for it completely or more than that when the market corrects thereafter. And this has been the symptom all through, and I think that is derived from this particular behavior can be completely attributed to It's, quality focus. It never has any unknown or very unusual name. It never gets into speculative part of the market. Only recently, few years back, we saw the fund manager leaving, who was managing it through the entire life of the fund. And I think, the migration has been very smooth. So we are, this is a kind of fund which one should have, one or two such fund, and one can well be taken care of reasonably well.
Virendra, what's your rating of the Franklin India Prima Plus for Investors Guide?
For all that I have said, it definitely deserves a 5-star.
5 stars for the Franklin India Prima Plus Fund on Investors Guide. Now remember, 5 stars is fairly hard to come by as a rating from Virendra Kumar. So this is a fund that we can all safely hold in our portfolios and not worry about at night. Let's move on to our hold or sell segment. We have another woman investor who's written in. Lalita has written in. She and her husband have been investing 8,000 rupees a month in mutual funds for the last 30 months. And she tells us she can continue for the next 4 years. The idea is to build a corpus for her retirement. Well, my first question to you, Virendra, is that if we look at a 4-year horizon, inching towards retirement, it might seem like a slightly aggressive portfolio. Secondly, she has 3 funds from Canara Robeco and 2 funds from Reliance. Does she seem a little overexposed to just these 2 fund houses?
Entirely depends, what kind of fund. And ideally speaking, great diversification can be achieved with, just 2 funds. Having a set of funds and, a combination of aggressive or conservative fund, I think one tends to be a little more conservative as one is, approaching retirement. So I think it should be approached with more stable vehicle.
Let's take a look at the funds that she has, Virendra. I'm going to take the Canara Robeco list together because there are 3 funds there. There's Canara Robeco Emerging Equity, there's a Canara Robeco Tax Saver, and the M-Force Fund. Should she hold on to all 3 of these, or would you like to trim that exposure?
Yeah, looks like, not much thought has gone into building this portfolio, or it is not a portfolio, it's a random collection of, funds in which SIP is being made, which is good enough. It's better than nothing. But I think more thoughtful exercise can translate into a superior investment performance. I think, this Force Fund was a very impressive fund, but it's something like, it's a thematic fund, and it should not be part of such a long-term portfolio, because the idea of, there was a time when this concept made sense. It invests in only 3 sectors, and it doesn't make sense to be, part of a long-term portfolio in which you are accumulating your savings from an individual investor. So this is a fund worth dropping.
All right, so out of your Canara Robeco holding, you can drop that 1 fund. Virendra, she also has the Reliance Equity Saving Fund and a Reliance Gold Savings Fund. I'm not sure if she's planning for her retirement, why she has a gold savings fund. Would you like her to exit that fund?
Yes, absolutely. And even on if you look at it from an investment, how it is performing, it doesn't make sense. And also on a long-term basis, I don't think it will stand it'll compare anything with, my sense is even with fixed income, leave aside equity. So long-term accumulation portfolio and having gold as part of that, it doesn't make sense. It should not be part of it in the first place.
Last fund on the list is HDFC Equity, Virendra. Continue this investment?
Yes, HDFC Equity, despite it not being in favor for a while, it's a fund worth carrying on. And I would say that, despite her selection of funds, of which only one is a fund where she might be constrained, which is a tax saving fund. So I would say that choose 1 or 2 funds, maybe, choose the aggressive balance fund from our stable growth portfolio, 1 or 2 of them, and be at it. Don't, and maybe discontinue this whole portfolio. And that will provide you, my worry is that, 1 or 2 years before your retirement, you will see the market going down by 10%. And that will be psychologically a very uncomfortable thing to be in.
All right, Lalita, while we understand you've put together this portfolio, Virendra, they're advising you to exit 1 or 2 funds, but it would make more sense for you to start investing in our stable growth portfolio that's on your screen right now. In fact, someone from our team will forward this list to you. You can start moving all fresh investments to this portfolio. Any investment you've made to your current mutual funds a year ago will be free from capital gains tax, so you can move those as well. So consult your tax, your tax consultant, and then start to move to our stable growth portfolio. Virendra there says you'll be far more comfortable as you approach retirement in this portfolio than in the one that you are in right now. Virendra, thank you so much for joining us and answering all of our questions. It's always a pleasure.
Thank you.
Coming up after the break, we'll tell you if it makes sense to book profits on your mutual funds. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. It's time for us to look at your asset allocation. Ashish Shankar, Head of Investment Advisory at Motilal Oswal Wealth Management, joins us to answer those questions. Ashish, thank you so much for joining us.
Thank you very much.
And welcome to the show. Our first question for you comes in from Kamlesh. He's been investing 2,000 rupees a month in the Kotak Gold Fund. He wants to know whether he should hold on to this fund. And there'll be a lot of viewers right now who are looking at their gold funds with a certain amount of discomfort because gold has been doing so badly. And the outlook on gold is not great either. It's expected to go down even further. What's your advice for Kamlesh and everybody else who's holding gold funds?
If you have a time horizon of 3 to 5 years, we honestly believe that gold may not be a good investment asset class to invest in. Reason being that gold has short bursts where it does well, and then it has a prolonged period where it is flat. And if you look at it from a longer term perspective, gold ends up giving slightly marginal better returns than inflation. I would suggest that you should switch to a good diversified equity fund, and even your further SIPs should go into an equity fund, because from a 3 to 5 year or a longer term perspective, I think equity should give you much better returns over a period of time.
Well, SK Gupta has written in, he's going to retire in the next 10 years and he wants to start investing 10,000 rupees a month in mutual funds. He's shortlisted a couple of funds. He's looking at the HDFC Mid Cap, Franklin Prima Plus, Reliance Banking, and he wants to know what you recommend. Now, Ashish, the first two funds are great if you have a 10-year horizon. I'm not so sure about the banking fund. I don't normally recommend that investors should look at thematic funds. What would you recommend he does?
I think HDFC Midcap Opportunities and the Prima Fund are very good selections from a longer term perspective. I strongly believe that if you are looking at a medium to long term horizon, then a sectoral fund has its limitations. Sectoral funds have to be exited once the sector becomes unattractive. So I would advise not to go ahead with Reliance Banking Fund. Rather than that, look at a diversified fund like a Reliance Equity Opportunities Fund or a Reliance Midcap Fund for the SIP.
All right, last question on the show. Another woman investor, Namita Gupta, has written in. She's been investing 40,000 rupees a month in mutual funds. She wants to know if she should book profits from her funds. And, the ones that she's been investing in, they've given her returns of 15 to 20%. Namita, we should always have a goal in mind when you start investing. So, for example, if you're investing for a home that you're going to buy 10 years down the line, then any 15, 20% return that you get is just going to get compounded and grow further and further. But I wouldn't recommend that you book profits unless you reach your goal or you have a plan for that money. But let's find out what Ashish thinks. Ashish?
It is very difficult to time equity markets, and if your time horizon is long, which is the case, I would suggest not to look at profit booking. You should continue doing your SIPs, and as and when you retire, you're looking to withdraw money. At that point in time, the monies can be shifted to slightly more conservative options like bonds or fixed income, post which you can enjoy a regular income from your savings. I strongly believe that if a fund has very strong long-term track record and it is going through a lean patch and the fund manager is still intact, you should not discontinue your SIPs in that fund or investment in that fund. You should continue with it. If there is a prolonged period of underperformance and the rating keeps getting downgraded on a sequential basis, at that point in time you could look to redeem and move to a better performing fund.
All right, that's a wrap on Investors Guide this week. Thank you for watching. You know how to reach us. Email ID is on your screen. You can reach me personally on Twitter as well. Tune in next week to catch the show.